Hi there, welcome to Kneppy Invest. Time to do another financial year 22 result video. And in today's video, we are going to be featuring a high quality company on the ASX, and that is Objective. Share price of this company was about 50 cents 10 years ago. Now it's $15. So this has been a 30 bagger for those shareholders who kept the faith, who bought into this company 10 years ago. And to be fair with you, this company has been around a long time. I think it was founded in mid 1980s. So it took a long time for this company to achieve success. And when it really hit that really important inflection point about 10 years ago, we have seen the valuation of this company really take off. Now, there are two reasons why the valuation of Objective have increased over the past 10 years. Financial expansion, so profits, cash flow, revenue have all increased during that time period, but also because of multiple expansion, which means the valuation metrics have also increased. So the market is much more willing to pay a premium for Objective shares right now than it was willing 10 years ago. So why is the market more willing to pay a premium for Objective shares today? So I'm going to sort of talk about that during the rest of this video. So not only look at the financial year 22 results, we'll also have a look at the valuation metrics, because I would consider Objective to be a high quality company. It all comes back to value. Is there any value in this company right now? And I've already answered this question, and this is probably the most important question when it comes to my own investing strategies or style. Discerning between whether a company is high quality or low quality, because if a company is high quality, it all comes back to the value. If I find a company to be low quality, it all comes back to the trend in the share price. And because I do consider Objective to be a high quality company, it's all about the value. Now, just because the PE ratio might be high doesn't mean this company is overvalued. That is something I think a lot of investors are confused about. High PE ratios don't necessarily mean a company is overvalued, particularly if a company is growing really strong. And Objective is growing at a really good rate. And in fact, I could argue we might see those growth rates accelerate. And I think the market is thinking that as well. And we'll discuss why during the rest of this video. But at this point in time, it all comes back to the value. Is there good value in Objective right now? Now, for full disclosure purposes, I am not a shareholder of this company. In fact, this is one of the few tech companies I have never been a shareholder of. I'm not sure why. I discovered Objective way back in about 2014. I thought it was a pretty good company then, but it was still fairly small, much smaller than it was now. But for some reason, I never took a position. And even though we should not fret about any decisions we have made in the past, we should not agonize about those sort of decisions. This could be one decision I might agonize about. But again, I don't agonize about not buying into Objective. About 8 years ago, I learned from it. That's the whole point. And that is how we grow as investors. Learn from our mistakes. And not buying into Objective 8 years ago was not necessarily a mistake. It was just a decision. And more than likely, I decided not to take a position in this company and take a position in another company. And we have to compare how that decision or how successful that decision was. And more than likely, it was probably not a very successful decision based off how Objective has done since 2014. And here is the long-term chart for Objective going all the way back to 2012. So 10-year chart. And back in 2012, the share price of this company at one point was 50 cents. And even though the share price did rise from about 2012 all the way through to, we'll say about 2019, just before COVID-19, share price rose from about 50 cents to say $3 to $4. It was really after COVID-19 where we saw the valuation of this company really take off. So pre-COVID, the share price Objective got to about $7, and the high after COVID-19 was actually $22. We have seen the share price of Objective pull back since towards the end of 2021, and that's understandable because this is a tech company, and there has been a lot of sell-offs in tech companies, even profitable tech companies, and this is one of the only profitable tech companies, it seems like. But even though it has pulled back, you still could argue maybe it is still overvalued. I'm not going to say that right now, that it is overvalued, but even though the share price has fallen from $22 to around $15 or so. Even though the share price has dropped about 33%, there still are arguments, just based off the PE ratio, that this might be expensive. But again, I've already said, just don't look at the PE ratio and think a company is expensive. If it has a PE ratio of 70, if it has a PE ratio of 100, or even 1,000, there could be some other reasons why it has a PE ratio like that. It could be growing at 1,000%. And if a company has a PE ratio of 1,000% and is growing at 1,000%, their profits at 1,000%, then it's not necessarily expensive. Although I don't know of any company in the world, probably in history, that has a PE ratio of 1,000 and also is growing at 1,000%. Now let's have a look at Objective's financial year 22 results, and the share price just before closing on, what's today's date? 15th of November, was around $15.51. I'm recording this video around about 20 to 25 minutes before trading has finished for the day. So that share price might be a little bit higher or a little bit lower than what the share price is when you're watching this video. But at a share price of $15.51, the market cap of this company is just below $1.5 billion. Revenue financial year 22, 106.5, but the profit 19.6 million. And if you just compare the market cap to the profit, it does seem like this company is really priced at a premium, because just comparing that profit to that market cap tells me the PE ratio of this company is well above 70. So Objective needs to be growing at a really good rate, and it needs to keep growing at a really good rate to justify the current valuation. And there's no signs that it won't be able to grow at really impressive rates over the next, say, 5 to 10 years. Operating cash flow, 27.4, so a little bit better than the profit and the free cash flow, because this company didn't spend a lot of money in capital expenditure last year. So property, plant, and equipment was $26.2 million. One way I determine whether a company is high quality or low quality is just simply by looking at the long-term chart. A 10-year chart can sort of give it away whether a company is low or high quality. And if you look at a longer term chart, say 20, 30 years, that's even a better clue on whether a company is high or low quality. Another thing I look for is revenue growth, and in particular, revenue per share growth. That's even more important, because some companies will make a lot of capital raisings, increase the shares on issue. Some companies do share buybacks. So it's really important to look at the revenue per share growth, in my opinion. So I have done that with Objective Corporation, looking at revenue growth without revenue per share. So revenue has grown from $39.7 million to $106.5 million over the past 10 years. The other thing I've included here is operating margins. And the other thing is, with Objective, is not only are we seeing revenue growth and pretty good revenue growth, we're also seeing really good growth in operating margins. And this is really important. So even though revenue per share have been growing between about 10.6% per year over the last 10 years, up to 19.3% over the last 3 years, so you might argue that revenue per share is growing. Because operating margins are increasing, that means the earnings per share of this company are actually more impressive, or the growth in earnings per share is more impressive than the revenue growth. So let's have a look at earnings per share growth over the past 10 years. So this is the earnings per share growth for Objective Corporation, or this is actually the net income. And then on the left-hand side, I've just looked at or calculated the earnings per share growth over the last 10 years, 5 years, and 3 years. So this company was only profitable by about $4 to $5 million between 2012 and 2016. And then all of a sudden, the profit started to take off. And you can see it really accelerating over the last 3 or 4 years. And you can see that when you do calculate the compound annual growth rate in income, or in fact, this is earnings per share, because I've calculated the growth in income per share, which is earnings per share. So over the last 10 years, earnings per share have increased at 17.1% per year. Over the last 5 years, 20.4%. Over the last 3 years, 28.6%. So just based off this and based off the revenue growth, everything is growing or accelerating over the last few years. And the question is, can this company continue that? And I think it can. And there are reasons why I think this company can accelerate the growth over the next 5 to 10 years. And if they can, this company at a PE ratio of above 70 does not look expensive. Now, I actually have not discussed what Objective actually does. It is a tech company, so they supply informational technology software and services, primarily to governments. So they break down their revenue into three different groups: content and process, regtech, which is regulatory technology, and planning and building. By far, their biggest product group is content and process. That's at $74.2 million of revenue. Regtech is at $20.4 million, and planning and building is, I won't say the least successful, but it's the smallest of their product groups at $11.8 million. And it is actually also growing at the slowest rate. Probably regulatory technology segment is growing at the quickest rate. In fact, that grew at about 33% from 2021 to 2022. One thing they didn't provide is any sort of breakdown in terms of margins of these different product groups. I would like to see that information. Maybe there's not much difference in the margins between these three groups. So, and the reason I want to know that is because it does look like RegTech is growing at the quickest rate. Does that product group have higher margins? And if it has higher margins, that means that the company's revenue, or maybe not revenue, but the company's margins might be accelerating from where they are now. And this is actually really important. This is one of the reasons I really like Amazon, not because of their commerce side of the business, but because of their Amazon Web Services, which has significantly higher margins than their retail side. Now, they do break down their product groups and exactly what they are. So content and process has quite a few different. Now, I haven't explained or haven't mentioned some of the software that this company has provided. So I'll just do that right now. For instance, they do have Objective Build, which is a building application management platform helping the construction sector and local governments. We have Objective Nexus, which is a SaaS-based solution providing records compliance, enterprise scale information management, and process automation. They also have Objective RegWorks, which would fit into the regulatory technology product group, which is specifically designed for regulation, compliance, and enforcement. And they have a lot of different other software at the moment. So go to the website, go to their annual report, so you can just see all the different sort of software packages they have on their website and in their annual report. So in their content process, they have Objective Enterprise Content Management related products, so Objective Connect, Objective Redact, Objective Keystone, and in their RegTech, they have Objective RegWorks and Objective Reach, and in their planning and building, they have Objective Trapeze, Objective Alpha, and Master Business Systems. Another thing I like to do is to look at the breakdown of revenue by geographic location. And most companies will provide this sort of information, if not in their presentation, in their financial statements. It'll be somewhere in the notes where they will break down their revenue by different segments or groups and also by geographic location. This is actually really important. I just want to know where they're deriving most of the revenue from. And it's definitely in Australia. So 80 million of their $106 million was derived in Australia. In United Kingdom, 11.3 million, New Zealand, 13.8 million, and rest of the world, 612,000. So this tells me this company has a potential for a lot of growth if they start to expand overseas and other countries realize this company can provide a special skill set to, well, it have to be, government organizations, realize this company can provide some services and solutions that they can't find anywhere else. And those services and solutions are much needed. That's the other important thing. Government organizations will have to realize they are needed. I think that's one of the most important points about software. The end user have to feel they can't live without that. And maybe that is what's happening or has happened in Australia and is happening right now in United Kingdom and New Zealand with Objective software packages. Now to valuation metrics for Objective. And for those who would call themselves a value investor, these are probably absolutely awful numbers because Objective has a P ratio of 75. Now, 75 does not necessarily mean Objective is overvalued if they can grow at significant rates. And we'll talk about the reverse DCF towards the end of this slide. Price to sales ratio, so 13.8. So this company is trading at 14 times revenue or sales. That's not necessarily high, particularly because Objective is profitable and cash flow positive. price to operating cash flow, a little bit better than the PE ratio. And I prefer to look at the price to operating cash flow, or even better yet, the EV to operating cash flow, because more than likely objective is net cash. And price to operating cash flow right now is at 53.6. So I did calculate a reverse DCF. So reverse DCF looks at the growth in this company, or the growth the company has to show to justify the current valuation. So that is a 10-year growth. So objective would have to grow at 33.5% over the next 10 years to currently justify the valuation. I think the company can do that. But be warned that if this company makes one misstep, just one misstep could drive the share price down a lot. So that is one thing to be mindful of if you are a shareholder of this company or you are thinking about becoming a shareholder of this company. Another way you could look at this is just look at the risk and the rewards. Are the rewards necessary to have that risk of this company not having one minor misstep? All it needs is one minor misstep. Now, that one minor misstep could drive the share price down 50%, but that could lead to an opportunity to take a position in this company if you are patient. But that one misstep might never come. So that's the whole thing you have to decide upon if you're an investor and you really think this company has a very bright future and you think this company can achieve growth of 33.5% per year over the next 10 years. There's actually one other scenario where the valuation of this company actually falls over the next 10 years, yet the company doesn't make any missteps. And that is if we go through a period where this company undergoes multiple contraction or compression. This has happened to companies in the past. It happened to Microsoft, and I think this might be the most famous case of multiple contraction, where Microsoft actually grew. So they went through financial expansion over about a 10-year period, but the share price absolutely went nowhere because at the beginning of that 10-year period, the PE ratio of Microsoft was really high, say 70, and then at the end of that 10-year period, the PE ratio of Microsoft was like 12 or 13. And during that period, even though the company grew, the share price went absolutely nowhere. So that is another potential outcome for objective moving forward. So you have to understand that if you are willing to buy shares in this company, you have to understand that the market might not be willing to pay a premium for this company in the future. And if it's not willing, the share price might not do anything. But anyway, this is the P ratio, the historical P ratio of objective going back to 2012. And if you look at the period between 2013 or 12 and about 2017, the P ratio of this company grew from about 10. Yes, you could have bought this company back in 2013 and 14 at a P ratio of 10, if only we knew the future. But even during 2016 and 2017, the P ratio of this company was just above 20. So even now, 20 for this company, or P ratio of 20 for this company, looks really low. But from about 2018, just prior to the COVID-19 financial panic, all the way through to really the end of 2021, there was a long period of multiple expansion, which means a P ratio went from a 30, which was right at the beginning of 2019 or the middle of 2019, all the way to 130. That is the very definition of multiple expansion. When you see P ratio go from 20 to 130 in about 3 years, that is the very definition of multiple expansion. And since that high in the P ratio, the P ratio has pulled back to 75. So right now we are under, or objective is under a period where it is seeing some multiple compression. And another way to look at multiple compression is just with the chart. So you can just see the share price going down in a fairly, I won't say orderly pattern, but there is definitely a downtrend line you can draw here. And that downtrend line is portrayed by that sloping dashed line, where every single time it gets to a sort of a mountain or a peak, that's the top of the trend line. And what we're waiting for is that trend line to be broken. And possibly the trend line has been broken over the last 2 days, but there have been bears coming in, sellers coming in, driving the share price right down to that trend line. That's happened the last 2 trade days. Did look like there was a breakout in the share price past that particular trend line, and then selling has come in forcing the share price to get back right on that trend line. So we can't say right now that Objective's share price has broken through this downtrend. We need further confirmation because there has been a little bit of selling the last few days. But you can just see that a well-defined downtrend that we keep seeing lower highs and lower lows, although the most recent low was slightly above the lows we saw back in June. So this could be a higher low. What we need to see is now a higher high, which means the share price needs to get above about $17, $17.50, which was the highs we saw in August. But still, Objective share price right now is in a downtrend, but it is looking a little bit more promising than it was looking a few months ago. I plan to do quite a few more of these financial year 22 results video, although most of the results came out in August. We're now in November, so 3 months on, but they're still relevant. Still relevant until we start seeing some of the half yearlies or even yearlies come out in February, which is 3 months away from now. So the next 5 videos I plan on doing in this series include Hansen Technologies, Myer, SRG Global, Domino's Pizzas, and Australian Clinical Labs. If you do have a suggestion, just leave it in the comment section of this video. Preferably, any suggestion will be a company that is profitable, has revenue. Now, the revenue doesn't have to be growing necessarily because I am doing a video on Myer, and Myer has been a basket case over the past 5 to 10 years with falling revenues. But when you look at the Myer chart, it looks a little bit more interesting. Probably the most interesting it's looked in the past 5 to 10 years. SRG is a suggestion that someone did give me, so I'll have a close look at that company. I don't know much about that company. I know a lot more about Hansen Technologies, a lot more about Domino's Pizzas, and a lot more about Australian Clinical Labs. So if you do have a suggestion, just leave it in the comment section of this video. That's all I have looking at Objectives financial year 22 results. If you have any disagreements with me, if you think I am completely wrong about Objective, if you think this company is undervalued, I'd love to hear your opinion. So leave it in the comment section of this video. If you think this company is completely overvalued, why would you ever buy into a PE ratio or a company with a PE ratio of 75? I'd love to hear your opinion as well. So leave any thoughts you have in the comment section of this video. And the last thing I should say is I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day.